and at the same time the money market instruments which we can use for either investment purpose or we can borrow the money. Remember, okay, I'll put it like this. The money market, the money market, okay, is a part of treasury. Then we the we can use the money market financial instruments for the purpose of to borrow, okay, for the purpose of short term, okay, I'll put short, mid term investments or borrowings. Okay, so meaning that here that the money market instruments which we can use for the short and mid-term investments or else for the borrowing purpose. Okay, so investment, if you have the excess funds, then you can go for the investment. Now if you have some deficit funds, then you can go for the borrowings. It's a depends on your business requirement. Then you need to decide, you need to do the configuration the product in the system. Okay, now okay, so this is the overview of I just given the, okay, the purpose of the money market. Then what we need to do, okay, with help of the money market, what kind of product types which are there in the money market. Okay, so money market products. Okay, I will explain you the once again the products and everything. Money market products. If we talk about the fixed term deposit, there are different product types which already SAP has given. Okay, these product types which we are going to call it as a under money market products. Okay, I will give one by one. Okay, first fixed term deposit, I am just giving deposit at notice. Then just for your understanding only, okay, the commercial paper, then interest rate instruments, again under interest rate instruments we may see the fixed interest rate and as well as variable rate instruments, interest rate instruments. Okay, I just have given the example here. Okay, apart from this there are many product types which we can create under the money market. Okay, that is fine. Now let us discuss about the one by one. Before start the money market, we need to understand the, okay, there are basic terminologies which we need to understand in the treasury. Okay, first let me explain you about the basic terminology in TRM. Remember, these you need to understand one by one. The terminology is important for you. Okay, then first we'll discuss about the what is mean by the product type. I'll put it product type. Okay, anyhow we will discuss all the things in detail again. Then first we will see that one, what is the product type. Okay, then okay, so the product type classifies, okay, so the product type which classifies the instruments okay, which classifies the financial instruments, classifies the financial instruments. Okay, if I would say what is the classification? Now, this product type which will be relevant for the fixed term deposit which are created under money market, and this product type, and let us assume the forex, the product type, it's a spot transaction, that will be is a different product type. So the product type which we can use for the classification of the financial instruments, based on the financial instruments, we will come to know what kind of product is this, and where, under which under which component, which treasury component we have done the either investment or it's a borrowing. Okay, so then product type simple, a product type is a classifying the financial instruments. Okay, and differentiate, differentiate, I'll put it one more word, sorry. Okay, so differentiation and the differentiation is necessary. Okay. Okay, differentiation is necessary as a individual investments, as a individual i- investment or borrowing. So now at the end, if we see the product type, okay, how we can understand either it's an investment or borrowing based on the transaction type, we will understand. Okay, now we'll see that what is mean by the transaction type. Okay, so the transaction type which will give the for every product. Okay, so for every product we will we must have to create along with the transaction type. Without transaction type we cannot create any deal. Okay, so now transaction type, so this and all these terminologies will be continuously repeating until end of the treasury, remember. Okay, you need to become familiar all these terminologies. Okay, the transaction types, the transaction types are defined with respect to product type, and it will be subdivided again. Okay, and it will be divided into the subdivided, not deviation, subdivided the product type by the transaction. So when I say this one, the sorry, so the transaction types are defined which okay, defined, okay, okay, defined with respect to the product type. Okay, so now meaning that here whenever we are creating a product type, okay, what kind of product, what kind of transaction type is relevant, let me show you here in the system. If I go to money market, anyone, you can take anyone under transaction manager, go to money market transaction manager, transaction types, define transaction type. Okay, here you can see here for the product type 51A, either I can the transaction type which has been associated, okay, with this product type is 100, 101, and 200, 201. Okay, what is meaning of this one? So the meaning here is that we need to understand with product type 51A, either I can do the investment or I can go for the borrowing. See, now you can see here, you just understand the logic here. So that is what I mentioned. The thing here is that the transaction types are defined which product with product with respect
Vijay,
to the product.
sorry,
Then
Vijay.
yes, tell
Uh,
me.
uh, Shankar trying to connect to the call, but it looks, I think you need to accept him.
No, no, no. I think maybe you can also okay. You can also admit.
No, but for me it's not showing.
No, no, I have admitted him.
Yeah, okay. Thanks.
No, yeah, thanks. No problem. No worries, Ravi. Okay,
Yeah.
so the transaction types are defined, okay, with respect to the product type. So the meaning that whenever we are creating any product type, okay, we must have to define along with the product type. See, initially we must have to create the product type. Then when we are making the relationship, okay, so when we are defining the define transaction type, so that we must have to define these transaction types along with product type. Okay, this is what I have explained. Then once the transaction type, then the next one is that derived flows. Derived flows. Okay, so what is mean by derived flows? Okay, so the derived flows are, so the derived flows are rules defined and assigned that are automatically created. So sorry, so here the flows we need to understand, two types of flows are there. Okay, so we need to understand flows are two types in SAP. Okay, sorry, in Treasury, two types. What is mean? What are the two types? One is the, if I say, then one is the main flow. Then second one is that derived flows. So what is the difference between main flow and derived flow? Okay, so the always the derived flows will be created with reference to the main flows only. Okay, first we need to understand what is the main flows. Okay, now when I'm posting a business transaction, let us assume main flow. Main flow, we need to understand the concept of main flow. Okay, so the main flow, we can take the example. Okay, now let us think about, I have done the investment, okay, in the fixed term deposit. Fixed term FD. Okay, you just think about, imagine fixed term deposit. Okay, then we have done the investment. Let us assume is a 1 lakh rupees. Then in the year end, okay, so one or maturity, once the maturity will be happen. Okay, or else, okay, let us assume while doing the investment, let us assume 15th of April, 15th of April. So we have done the EFD. The amount which we have is a 1 lakh rupees. Then as part of the deal creation, we must have to bear some additional charges, like it's a transaction charge or it's a taxes. Let us assume we have to pay, GST. Let us assume the simple thing is that, okay, the GST, either you can go for the percentage or it's a fixed amount. Okay, so once you do the calculations externally, whatever however you want, then you just straightforward you can put it the amount here. That is the option number one. Or else if you want to go by the some certain percentage, you just give the some percentage, 18 percentage GST. So here you can understand here, this is the main flow. See, main flow is the when we are doing the investment, okay, this is my main flow. Then with help of the main flow, because I want to calculate GST on my investment, or it's a depends on the rules which has been defined by the government. Okay, then I'll put it is the 5%. Okay, let us assume is the 18% is a more, then put it as a 5%. Then this is the derived flow. Okay, so what I mentioned here, the derived flows are rules defined and assigned that are automatically created, and those will be determined created automatically created. Okay, when we perform the main flow, when we execute the main flow, automatically the derived flow also will be executed. Okay, so then here there are conditions. Okay, in order to derive or we perform the activity, okay, what we need to do, we must have to specify certain conditions. That is what the derived flows. Okay, without main flows you cannot generate the derived flow. Remember, this is the main flow, this we need to consider is the main flow, this is the derived flow. Okay, but without main flow we cannot perform or we cannot generate any derived flow. Okay, then
So, sir,
so
at
the
the time of hello,
yes, tell me.
yes, sir. Sir, at the time of creating contract, we have to just example we create the a contract for the fixed term deposit. So,
Hmm.
if we add any charges like GST or bank charges,
Exactly,
then that is called the derived flow, right?
exactly. See here, whenever we are creating, I'll give the example here. When slash n ftr underscore edit, so I'll take any one of the transaction here. Let me display here. You can see here other flows. Okay, here you can specify which you want. Okay, see the flow type you can specify here. Only if you take a drop down here, only as I mentioned here, only these flows will be appear, the main flows will not appear here, either charges, withholding taxes, okay, GST, which you want, which you have defined. Okay, then option number one, then the option number two is that which we want to derive without other flows. Okay, without other flows, you can see here nominal interest for others. Okay, for other flows even I have done the configuration. Let's see that one. 5, let's see that cash flow
So, sir,
transaction.
other flow that will be defined means that a standard SAP has been given,
Yes,
and
yes,
for
yes,
define whatever we need to define automatically coming to the cash flow that we need to
yes,
configure,
automatically.
right? Okay.
Yes, that we need to configure. Okay, that I will show you. Okay, there are other product for other product types which I have already done the configuration executed. Okay, so I will show you that one. Then that is the meaning of the derived flows. Then when I was talking about flow types, okay, flows, okay, let us see that one. Flow types. Okay, so the flow types define the flows of flows of a trade for, okay, the flow types. Okay, okay, flow types define the flows of the trade. The flow types define, okay, define the flows of trade. Okay, so here what exactly meaning of this one flow types. Okay, so now let us assume I have created a deal here. I have created the deal on 15th of April. Now, once the deal will be created, the money we have to, okay, let us assume we have done the investment. Then we have successfully created the deal and we have transferred money from our bank account to the, okay, the counterparty's bank account. In such situation, we must have to show the accounting entries in the books of accounts, okay, for the deal creation and as well as the, okay, the money related transaction, okay, the financial transaction. Then if I want to perform these transactions, the flow types will play the key role. Okay, without flow types, we cannot create the document into the treasury. Sorry, into the in accounting. Okay, the flow types will play the key role. Okay, that is what I was telling that one. Okay, so the flow types define the flows of the trade. Okay, then about the derived flows, I have already explained. Okay, derived flows. Then the next one is that, okay, I'll make it this one, identify separately. Okay, then condition types. We need to understand the next one is the condition types. So what conditions do we require? Okay, whether do we require the condition type? First of all, what is condition types? What condition types which we can use? Okay, so the condition types, okay, let let us assume the condition types controls how flows calculated. The condition types controls how flows are calculated. Now, what condition types do we require? Let us assume I have done the investment here. On this investment, okay, on this investment, then the maturity period we can assume it's a yearly. I mean, the maturity period may be after 1 year, after 3 years, or after 5 years. It depends on the, okay, the bank. I mean, the counterparty and my organization agreement. Then until the maturity period, what we need to do, we must have to perform the accrual and deferral. Okay, so the accrual and deferral is a part of the month end activity. So what we need to do, we must have to define the conditions. Okay, the conditions, let us assume the interest. I am telling to system the interest rate per annum. Okay, per annum, per or yearly, the yearly interest rate I'll mention. The yearly interest rate, let us assume, is a 10%. Now the 10% on this 1 lakh rupees, the total 10,000 rupees yearly total interest. But now the interest 10,000 rupees which I receive once once in a year. But now what my finance department asks is that, okay, then we are receiving the interest yearly. That is fine. But now it should not impact our P&L account or balance sheet at once or at a time. So that is the reason what they will ask, perform the month end accrual and deferral activities. So okay, what will happen? Okay, when we perform the month end activity, month end activity is a accrual or deferral. Accrual and deferral which we need to perform. Then the 10,000 rupees which we may be yet to receive, okay, but now that needs to be divided into the, remember, this need to be divided into the 12 periods. Okay, so now this amount to calculate this one, the monthly, okay, either it's a yearly interest calculation or monthly interest calculation. What I need to do, I need to define the condition. First of all, I need to define the condition. Hey, please go and calculate the interest rate is at 10% on this investment. Okay, now again the condition will be a, okay, the monthly accrual and deferral when I am performing, this has to be divided into the 12 months. This is what the condition types which we need to define. Okay, without condition type, we cannot calculate the interest. But remember, the conditions will be used in the money market, then forex doesn't require conditions. Okay, we'll see that one, which instruments are required the condition types and which instruments are not required the condition types. Okay, then okay, we have seen about the condition types. Then so there is a 1:1 relationship, okay, between the condition types and the flow types. Remember, there is a 1:1. Remember, you need to understand there is a 1:1 relationship between condition types and the flow types.
Yeah.
So when I say this word, then one condition, okay, the condition, the flow type, if I have the one condition, if I want to define that one condition need to be interlinked to the flow type. Okay, one condition I can link to the one flow type only. I cannot correlate multiple condition types to one flow type. This is what the meaning. We cannot correlate. Then the next one is that update types. Okay, see, no need to take any note because in the I have already prepared a document. So in that document, you will see that more and more. Okay, no need to just it is for all. Okay, do not take any note. Just concentrate here. Then update types. Okay, now what is update types? Update types controls the posting of individual flows. Update types controls the posting of individual flows. Okay, then the update types identify the flow. Okay, now if I want to update this, what I would say, let us assume this fixed term deposit. This is my this is my principal amount which I am investing. Then this is my nominal interest. Okay, how system will identify? Okay, how system will know this is my principal amount, this is my nominal interest. Okay, in such situation the update types will be, okay, so the update types will be identify the flows. Okay, that is what I mentioned. Update types controls the posting of individual flows. Okay, what needs to be updated. Okay, then and also at the same time there is a one which we need to map into the, okay, so it identify flows and it will display into the position management position management procedures. Okay, so I just have given the brief explanation about here. Then okay, so up to here these are the terminologies which are quite common. Okay, so the flow type we have seen about the product type, the transaction types, derived transaction type, derived flows. What is meant by derived flows? These are the terminologies which will be quite common in the treasury. Okay, for all the financial instruments, either you can talk about money market, forex, securities, derivatives, okay, and as well as trade finance. Okay, these are the terminology which will be repeated constantly.
So
Then
Vijay, can you go up where the flow
yes,
types? So flow types, derived flow types.
which one?
There are two things in the under the flow types.
Yes,
Normal
flow
flows and
types.
derived.
See, the flow types define the, okay, flows of the, okay, trade. Flows
Okay.
of the trade. When you perform the trading activities, okay, it will flows of the trade. Okay, it will derive. Okay, the flow types are defined different. Okay, flow types define the flows of the trade. Okay, when you perform the trading activities, that needs to be identified by the system.
Yeah, got it.
Okay. Then condition types. Then as I explained here, the flows are two types. One is the main flow and another one is the derived flows. Then, okay, fine. Now, so I just have given the brief explanation here. Then we'll go to the again we'll go back to the money market. Okay, so the purpose of the money market is for the short term and mid term investment or for the borrowing purpose. Now let us see the scenario how we need to structurize the product. This is a very important one. Okay, to structurize the product, then if we understand this one, then we can easily, okay, do the configuration in the system. Okay, now let us think about, okay, as part of cash flow analyzer, as part of, or I will put it as part of the cash management, they have identified, okay, the cash manager. Okay, I'll mention the cash manager has been identified. There is a, there are some, okay, I'll mention there are excess funds. Excess funds in the organization. When I say the excess funds, don't treat that those excess funds is a part of the reserves and surplus. Okay, so the reserves and surplus
Idle
which we
funds,
can,
maybe idle
yes,
funds you can call
idle
it.
funds, exactly idle funds which does not have any operational activities, which should not have any, it should not impact any business operations. Then 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 see, now we have excess funds. Okay, so the cash management or cash manager, once he will identify the excess funds, what he needs to do immediately, he is not the right person or correct person to take the decision immediately go and do some investments. Okay, then what we need to do, then the cash manager will call to will call to AP team. Okay, accounts payable team. Okay, how long the idle idle cash does not needed so meaning that, so he will discuss with the accounts payable team. Okay, how much time you do not want the excess funds. Okay, because maybe the accounts payable team, they are expecting in a 1 year, or it's a coming upcoming 6 months they have to make the payment, okay, larger amount. Okay, until the period what they will, I mean the management will take a decision and they will not keep the idle funds into their bank accounts. Okay, how long the idle funds does not required, I'll put it like this, idle funds does not required for for payments or for payments. Okay, let us assume that, okay, so the accounts payable team has given the confirmation the funds does not needed until 6 months. Okay, let us assume the funds does not needed until 1 year. Okay, we will talk about 1 year. 1 year. 1 year. Okay, I'll put it. So now the immediate thing is that what cash manager will do. Okay, the cash manager will discuss with, or will okay, will discuss with, okay, treasury. Hello. Hello.
Yeah, Vijay.
Hello.
We can able to hear you.
See
Vijay?
that, I mean,
Yes,
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 it's the
sir.
yeah, power fluctuation. Yeah, power has gone and again it is resumed. So that could be the reason. Okay, sorry for that. Okay, and now immediately the treasury department, okay, the cash manager will discuss with the treasury department and will take a decision to invest the money to
Investment.
invest the money. Okay, in see, I will just
Yeah.
ignore. Okay, money
Yeah.
market, it's irrespective. I will explain you
Yeah. Yeah.
now. When they have decided that they, if they want to invest the money, now let us talk about Ravi's point here. They have decided, okay, let us assume they have the excess funds. The excess funds is a 10 lakh, just for our understanding only. Now at this point of time, the management will think about, okay, treasury department or management will think about whether on their investments. Okay, see, anyhow, if they invest into the fixed term deposit or in the money market instruments, the less risk will be there. At the same time, the expectation, okay, the expected return also will be the decent return, and also we cannot expect, and also fixed interest amount which we can expect. That is the option number one. Then see, now I will put it here is that if the management do not want do not do not want to take much risk, sorry, much risk, and they are expecting some decent return on the investments. Let us assume now for 10 lakhs rupees, 10 lakhs rupees. Now this is the investment, this is the amount, okay, investment amount. Okay, now this is the amount. Then the interest, how much they are expecting? Interest rate. Interest rate, let's say, is a 10% or 12% per annum they are expecting. So in this situation, okay, if this if this will be do the investment, if they are doing investment into the money market instruments, the first thing is that no risk here. Okay, no high risk, I would say. No, no high risk, and the return would be, okay, fixed interest rate, fixed interest. The return would be a fixed interest on our investment. Option number one. If the management, okay, they do not want take the much risk, let us assume they are ready to take the risk. Okay, then option number one. What are the options they have in front of them? The option number one. Then let us discuss about the option number two. I'll take the same example here. Then if the management decided that, okay, they want to take the risk, they want to take they want to take more risk, and they are expecting the they are expecting a return also, a return on their investment, okay, return higher than the FD rate. Let us assume their expectation would be a, okay, I'll mention instead of this one, their expected return would be around 50%. Okay, even you can put it 90% also, doesn't matter here. Okay, you can think about is a 30%. Now 30%, you can imagine it's not the smaller amount, it's a risk. Okay, so it's a bigger amount only. Now Now the interest, okay, they are expecting the return. I cannot say this one is the interest. This is the return. Return they are expecting is a 30% on their investment. Here it's a high risk. It is there. Understand here, it's a high risk and the high return. High return. Here high risk and high return. Now before do the investment, what they will do? They will do the investigation. Okay, so investigation in the sense the market risk analyzer, what he will do, he will he will do the research. Okay, so now they have decided that they want to invest into the, let us assume into the some uh, Tata Steel. Okay, let us think about just simple thing is that, okay, now before do the investment, if they go for the high risk, or else they will take a decision they want to invest into the some forex transactions, or they will go for some future and options. But before do the investment, what is the current market price of the product, then whether it is running into the higher price or lower price, okay, what will be the future expectations, what was the past performance. So everything they will do the analysis and they will take a decision. But now if the trading, if the organization is a trading organization, then they will take a decision. Okay, they will take a high risk and they will expect the high return. But now my organization, the management, they are not ready to uh, take much risk. So in such situation, what they will do, they will go for the fixed, they will go for the money market instruments. So here we need to understand two things: high risk high return, low risk and low return. Okay, so that decision will be up to the business. Okay, business, what in which financial instrument they want to invest the money, it's a business decision. Okay, we cannot say that one. Then okay, now let us assume now the management has concluded they want to go with money market instruments. Okay, money market instruments is like a, let us assume money market instrument, when I say it's a fixed term deposit. Okay, they want to go for the fixed term deposit. Then now sorry, now they have decided that they want to, okay, fix it, they want to do the investment into the FD. Now let us think about the, now let us talk about how to structureize the product. Now understand this one. Now we need to structureize the product. Okay, now what we will do, once they will be decided this one, then the the treasury department will call to TRM consultant to run to okay, TRM consultant to run the cycle. Okay, TRM consultant. Okay, they will call to the TRM consultant to okay, map the or configure the product. Okay, let's say the configure the fixed term deposit product cycle. Sorry, product cycle activities. So
So,
when I say
Vijay,
here what
so
they will do, yeah, yes, Ravi.
every time, when they decide something and they will ask TRM consultant to configure it, and then, their end users will take care the further movements.
Exactly, exactly.
Oh,
But
okay.
but remember, Ravi, here,
Mhm.
see, when if the product type which is already available in the system, okay, let
Yeah,
us assume now the product type which is already available, again no need to define, right? Okay, we can
yeah,
reuse that one.
yeah.
Okay, if they have any particular requirement, okay, if they want to the other than this product, okay, if they want to define a new product type, then only we need to perform the configuration. Otherwise, the configuration does not need it.
So the standard ones they will use and they can create it, whatever they wanted.
That is what
But
see.
if they want new one, then only they will come back to Treasury
Yes,
Consult.
exactly. But one thing is that for our practice purpose, I'm not going to use any standard product type. Point
Okay.
number one.
Yeah.
Okay, because if we use the standard product type, what is the logic behind that? Okay, how the product is functioning, we do not understand. So that is
Yeah.
the reason. Okay, I will create complete new setup.
Okay.
Okay, then we will see that one. That is
Okay.
what even in the last sessions also I have explained. Okay, then then now the treasury department, okay, will call to the TRM consultant to do the configuration for the fixed FD for fixed. If they want to run a fixed term deposit cycle, the cycle, when I say the cycle, they want to create a new product type. Okay, if the product they want to use it, then what are the flow types, what is the transaction types, then what is the derived flows, and as well as what is the accrual and deferral, what is the position management procedures, account determination, all these things need to be in place, then only we can run the cycle. Otherwise we cannot run that one. Okay, that we will see that one now. So now our role is that, okay, now when they call to the TRM consultant, the TRM consultant, before do the configuration in the system, we need to, okay, system need to understand the structure of need to understand, need to understand the structure. Okay, okay, the structure of product, or we can structureize the product. How we can structureize the product in the system? Okay, structure in the sense how we need to uh, map that one into the system. Okay, now let let us take, okay, then how much excess funds we have? Excess funds, sorry,
1
excess
million.
funds. Yes, exactly. So we have the 10 lakhs. Okay, we have the 10 lakhs funds as a excess amount. Then once this will be done, remember, okay, I'll put it like this. One more thing here. Then it product type, then transaction type, then condition type, then
Flow type,
yeah, I'll
usage.
put the next one, flow type, and then last one is that correspondence.
Usage type, not required.
No, that is not required. Usage type is not required. Then now we have a excess funds. Let me now point number 2 is that now so in order to, okay, invest the moment when we have decided that, okay, so the management has been decided that they want to, okay, the management decided that first thing is that they want to invest in FD, okay, money market instruments. Okay, now in such situation, what will happen here? What will happen? Then what is the product type which we need to invest? Okay, now it's a FD, okay, fixed term deposit. Okay, we will create the new product type, okay, for this one. Then I just mentioned for our understanding product type. Then what is the transaction type? Okay, so there are two types of transaction types which are there. One is 100 100 is the investment. If I go here and show you, see now 100 is the investment, 200 is the borrowing. Okay, then so the 100 which we need to consider the transaction type. Then then condition type. As I mentioned, the condition type, if I want to calculate the interest, okay, I have already explained the okay about the condition. Now in order to calculate the nominal interest, I must required is a condition type. Without condition type, I cannot execute or I cannot calculate. Then